All right, Account Dad Squad, solo pod here today without Ash and Hubert, but we want to go into the budget in detail next week. And I thought I'll jump on quickly and talk about the 10 things that you may not have noticed in the budget. Now, I'm not going to talk about the CGT or the negative gearing stuff or the trusts, which I'm sure have been spoken about by many wiser commentators that you listen to, but I want to talk about 10 things that I noticed that you might not have noticed. I'm not even going to give you my opinion on the budget. I hated it.
That's a good point. I know I've done a Zoom where
I want to give you a neutral spin on the 10 things that I saw in the budget that you may not have. So let's kick it off. Number one, the R&D tax incentive haircut. What counts as R&D anymore? That just got way stricter. So what's changing? Well, from July 2028, you can only claim the offset on real experimental work, not the stuff around it. So people were claiming things like project management, a lot of fluff that sits around actual R&D stuff, like reading academic papers, reading patents, maintaining your lab, your workshop, your equipment, training, things like that. Now it's the actual experimental stuff that can only be claimed. So if you're a software company building a brand new AI algorithm like Safra that doesn't exist yet, well, you can't claim anything that sits around the actual development of this brand new AI algorithm. If you're a cabinet maker developing new joinery technique using recycled material, that's the only thing that you can claim. So in dollars, if you spent $200K on an R&D project and $80K of it was support work, well, you used to claim the full 200 before. Now you can only claim that 120K of actual experimental work with of which you have backing and evidence behind, I would hope. The good news is the offset rate on that core work goes up, right? It goes up from 25 to 50%. So it partially balances out for genuine innovators, but it will definitely make those R&D research teams or those accounting and tax companies that do the R&D claims to look at their claims a bit more tighter, and it'll help you to look at your evidence that you have that supports your R&D work in a bit more detailed way. So that's the first thing, R&D claim, which I thought was interesting. Number two, the loss carry back. So this has kind of been a temporary COVID measure that's kind of continued since then. And, they've always been touting that it might potentially be taken away, but that's been made permanent now, the loss carry back. So if your company loses money this year, you can apply that loss against profits from the last 2 years and get a cash refund of tax that you've already paid. So I'll give you an example, right? 24-25 financial year, your company might have made $500K in profit, pay $125K or something in tax. The next year, you made $300K in profit, you paid half of that or $75K in tax. 26-27, obviously, everything that's happened, interest rates, oil shock, all of these other global events that have affected your business, you now lose $400K. Now, the old rule is that your loss sits there waiting for future profits to offset that loss against. Since COVID, they brought out this rule where you can carry that $400K loss or that loss that you've incurred in the year against last year's profit and get a refund of around $100K or whatever that calculates to, cash back from the ATO. So now this rule is permanent and it applies to all companies up to $1 billion in turnover from income years after 1 July 2026. And the Treasury reckons around 85,000 companies a year will use it. So if you've got clients or if you are a customer or if you're a business with cyclical operations, like construction, hospitality, then this is real cash that you can pull back in those tougher years. So that's number two. Number three, startup loss refunds. So cash back on the tax that you've paid on staff wages. So if you started a new company and lose money in your first 2 years, you can now get those losses paid out as a cash refund, but it's capped at the amount of tax that you've paid on employee wages. So that's PAYG, withholding, and FBT. So example, you start a tech startup in July 2028, you hire 3 staff at $80K each, totaling to $240K. A total PAYG withholding is around $45K paid to the ATO. Year 1 in operations, you lose $300K. So you get $45K as a result back as a cash refund, capped at the employment taxes that you've paid. And the remaining loss obviously carries forward like normal. Right now, if you bootstrap a startup and burn cash, your tax losses sit on the books waiting for you to be profitable. So this means that founders who hire people can recycle some of that loss into actual cash, funding their next year of trading, which I think is a pretty positive thing for startups and boosts innovation a bit and boosts businesses and people wanting to take risks. So that is a positive. Number 4, PAYG installments going monthly. And your accounting software will do all the work. So PAYG installment. So the ATO makes you essentially pay your expected income tax in quarterly chunks throughout the year based on last year's tax bill. So if you paid 100K in tax last year, you cop 25K bills every quarter, regardless of how your business is actually going. So the problem is that if your business slows down mid-year, you're still paying installments based on last year's good performance. So now you can vary them down, but if you get it wrong, then the ATO whacks you with interest. And so most people just pay the full amount and, wear the cash flow pain. From 1 July 2027, however, you can opt into monthly installments instead of quarterly. And your accounting software, so Xero and MyOb, all the bigwigs, will use an ATO-approved calculation to work out your installment based on what your business is actually doing right now. And there'll be no interest charges if you vary down using this approved calculation that sits in the software. And there's a bit of an admin safe harbor that sits in there. So imagine you're a mom and pop business running a cafe. You've had a banger Christmas quarter, and the ATO assumes, Jan to March will be the same. But we know Jan to March is never the same, and it's dead usually for cafe businesses. Right now, you pay based on Christmas, and your cash flow gets absolutely smashed. In this new system, your software sees, actual Jan to March revenue is down 40%, and it adjusts your installment down as a result. So you're not essentially outlaying that cash, and there's no interest risk off the back of it. This is good because I love this. Brings down the compliance work. They reckon it'll save around 10,000 hours of compliance work a year. And it also helps accountants change how they advise their clients on installments. It goes from like a manual quarterly conversation to a real-time data feed, which is pretty good. That's how we want to get it, automated and through tech. Number 5, the EV salary sacrifice. FBT, tax on non-cash benefits, which a business gives its staff or directors, like company cars, gym memberships, paid parking. But if you put yourself in an EV under 75K through your business via a novated lease, there's no fringe benefits tax. Total tax saving over a 3-year lease is, about 10 to 25K, depending on the car and your tax bracket. But what they're changing is essentially that EVs over electric vehicles over 75K from the 1st of April 2027 will have no exemption. That full exemption ends, and it's replaced with a permanent 25% FBT discount only. But if it's under 75K, then you do get the full exemption. So that's pretty cool because, I talked to a lot of mates that talk about, should I get an EV through the business? The answer is yes. Lock it in before April 2029. Number 6. So this is not really business related, but a bit personal, but the tobacco black market just blew an $8 billion hole in the budget. Now, every year for a decade, Australian governments have hiked this tobacco excise, right? Today, a pack of cigarettes, I don't smoke, but a pack of cigarettes around $50-$60 from what I hear. And the Treasury has just assumed that smokers would just keep paying it. Well, what's actually happened is there's this massive black market now. And, organized crime has stepped in, funding this black market, and there's illegal tobacco and illegal cigarettes on the market, selling for about $20 a pack. So the numbers in this budget have shown that they're actually going to drop the excise. And it actually got me a bit annoyed because I'm like, mate, why don't you drop the alcohol excise? That's what you should be dropping. But I get that they're trying to extract money from any way they can. And I get that they've learned, which is good because Treasury assumed people would behave one way by increasing the excise, thinking they'll just keep paying it. But the market did something different. And so they've reacted as a result of it. And this hole is essentially why I think they've had to go a bit aggressive on the other parts of the budget as well, which is interesting. Number 7, observation again. I'm going to raise this as a point, but it's an observation. People say that they don't really talk about AI, which is true in this budget. But they do kind of mention their partnerships with Anthropic and Microsoft. And so they talk about this ai.gov.au launching as this official government AI resource hub. They talk about the AI Safety Institute being established, $70 million going into an AI accelerator through cooperative research centers, 106 million to speed up environmental approvals for AI and data centers and things of that, and AI tools being piloted to help builders work to the National Construction Code. So there's still some reference to AI there, which is good. And there's obviously not as strong a mandate on the future of the economy and the future of the AI space in Australia, but I like that there's still some mentions in there, which is good. Number 8, the biggest tariff cut in years. Who are the winners? So for those listening and who don't know what a tariff is, you probably have heard this overstated by Trump, but it's a tax on imports and you pay when goods cross the border into Australia. So even the small tariffs, right, they come with massive paperwork. Businesses have to correctly classify the goods, work out the duty rate, prove eligibility for concessions. And the paperwork often costs sometimes more than the tariff, which is the annoying part. So there's a couple of items specifically called out in this budget, particularly who will be impacted by these tariff cuts. Number 1, wine glasses. So feel like hospitality would benefit from that, or retail, homeware retail. Tires, so trucking, transport, fleet, anything that's been affected by all the fuel stuff recently will get that benefit through tires. Air conditioners, construction and HVAC contractors will benefit. Margarine, dang, okay. A real problem, because we're butter people over here at the Account Dads, and bitumen. So an example is, say a trucking business spends $200K a year on tires. They've been paying a 5% tariff, $10K direct cost plus admin time figuring out the classification. They now don't have to do that anymore, and that essentially has been cut down. There's another bonus as well. There's an Australia-EU free trade agreement that was spoken about in the budget. And that means that Australia has a free trade deal with a market of about 450 million consumers, which means cheaper imports from Europe. We're talking French wine, Italian leather, German equipment, and lower barriers for Aussie exporters. So if you got, if you're a customer, or if your business is sourcing stuff from Europe, this is a multi-year tailwind. Number 9. So this is paid parental leave. So this is increased to now 6 months. And if you're a business owner, what you need to know is that from 1 July 26, paid parental leave reaches that final threshold that they've been talking about, 26 weeks, 6 months, compared to 2022 when it was 18 weeks. And so eligible families around $14,000 better off as a result of this. And the government also pays super on top of the leave so that parents don't fall behind on retirement savings while they're raising kids. So it's good. We want to prioritize kids. We want to prioritize families, which this country has really fallen behind on. So if your staff in your business has babies, the government pays them, not you. It's not coming out of your payroll, but you got to remember they're off for 6 months, not 18 weeks. You need to think about backfill planning. And you also need to plan super contributions correctly during the leave period. The government handles it, but your payroll system also needs to know that, so you're not kind of double contributing. What else can we talk about? I think the last one is probably the family trust. Now, we spoke about, I said I wasn't going to talk about this because people have spoken about the 30% minimum tax on discretionary trusts from 2028. What they're missing is that the budget includes a fully supported pathway to restructure out of your trust without getting hammered with tax along the way. So what does restructuring out of a trust mean? So most family businesses, right, set up as a discretionary trust, usually with a company as a trustee and family members as beneficiaries. So to restructure out, you move the business assets and operations from the trust into a different structure, most commonly just a PTY limited company, or in some cases a fixed trust. But why would you do it? Well, if the only reason your business is in a trust is to distribute income to family members on lower tax brackets, which would be the smart thing to do, then the 30% minimum tax kills that benefit, which sucks. And, it's one of the reasons this budget has gotten a lot of criticism. But it's better to be in a PTY limited company where the small business tax rate is 25% instead of being charged at your income tax rate, potentially at the highest level. So they've built a roadmap into the budget. There's obviously CGT rollover relief, particularly around moving business assets out of a trust, triggering capital gains. The rollover means you can do it tax-free as long as you do it in this window, which is from 1 July 27 for 3 years. And from 1 Jan 27, the Australian Small Business and Family Enterprise Ombudsman gets funded specifically to help small businesses figure out what to do. So essentially, they're creating this administrative service, increasing government to support small business owners and small businesses to think through the right thing to do here. And ASIC is also setting up specific support to help small business incorporate, set up that PQR limit and access that 25% small business tax rate. So family construction businesses in a trust, like, is one I know I'm thinking about, distributes 200K to dad, mum, and 2 adult kids. And under the new rules, the trust gets taxed 30% on undistributed income. So what this family would do now is to restructure, move the business into a PTY limited with the company paying 25% small business tax rate. And with this rollover relief, they can do this without triggering CGT on the asset transfer. And so the Ombudsman essentially helps them weigh up the options. ASIC processes the incorporation and can help them out with it as well. So my advice to you, most will wait until 2028 when the trust tax bites. The smart ones, the real ones, will start the conversation with their trusts, with people with trusts or companies with trusts now, and have them sorted in that rollover window. Anyway, those are the 10 points, 10 observations that I've had. I'd love to hear any observations that you had that we've missed, that everyone has missed, really, because there's so much stuff in there that it's impossible to go through all of it. Point out what you've gone through, any tidbits, and point out any things you'd like for us to go through in detail as well, because we'd love to do this in our next episode in a bit more detail. Peace. Thanks for tuning into the Account Dads, and we'll catch you next time with all of us, hopefully. See you guys.